All right, let's get right into it. Look, we all want our money to grow, right? But the real secret to building wealth that lasts, it's not just about picking winners. It's about playing defense like an absolute pro. So today, we're going to skip the beginner stuff. We're talking about how the pros actually think about and manage risk to protect their capital. Because, let's be honest, one huge loss can wipe out years of hard-won gains. So here's the game plan for today. First, we're going to completely redefine what risk really is. Then, we'll expose the 6 silent threats that can sneak up on your wealth. After that, we'll build your first line of defense and open up the professional's toolkit. And we'll finish up by talking about the single biggest risk you'll ever face. And it's probably not what you think.
Okay, first things first. This is probably the most important step in the entire process. To shield your wealth, you have to know what you're actually fighting against. It's a small shift in your thinking, but trust me, it changes everything.
And here is the core difference. See, beginners, they see the market dip and they freak out. They panic. But a professional? They know that those ups and downs, that volatility, it's just the cost of doing business. It's the price you pay for long-term growth. What they really fear is something way more serious.
So this is it. This is the pro mindset. Real risk isn't just a bad day in the stock market. It's a loss you can never recover from. It's your investments getting wiped out. It's having to sell all your stocks during a crash just to pay the bills. It's damage that is permanent, and pros will do anything to avoid that. Defense first, always.
All right, now that we know what the real enemy is, let's meet its top agents. We're going to call these the 6 wealth killers. These are the things that can quietly, and sometimes not so quietly, tear down everything you've built if you're not watching out for them.
First up, the big one we all know, market risk. This is when the entire tide goes out, pulling even the best-looking ships down with it. You know, like in 2008 or that crazy dip in 2020. You can't avoid these storms completely, but you can build a boat that's ready for them. Then you've got inflation risk. This one's the silent assassin. It's that invisible force that just eats away at your money. Your account might say you're up 5%, but if inflation is at 6%, you've actually lost buying power. You're getting poorer, slowly but surely.
Next, there's credit risk. This one's pretty straightforward. It's the risk that someone who owes you money just doesn't pay you back. You buy a bond from a company, and that company goes bankrupt. Poof, your money's gone. Then there's liquidity risk, which is a bit sneakier. Imagine you own a house and you need cash fast. Well, if nobody's buying houses right now, you can't sell it. The value is there on paper, but your money is completely trapped.
And to finish off our list, we've got a couple of big ones for any modern investor. Currency risk. This can really bite you if you invest overseas. Let's say your stock in Japan is up 10%, but the Japanese yen falls 12% against your home currency. Well, you've actually lost money. And finally, there's regulatory risk. This is when the government suddenly changes the rules of the game. A new tax law, a new regulation, it can completely wreck your strategy overnight with no warning at all. Okay, we've met the villains. We know what we're up against. So how do we build the fortress? How do we defend ourselves? Well, this part is all about the foundation. It's about the core structure that professionals put in place before they even think about picking a single investment.
I love this quote. It's just perfect. Proper diversification is your first, your best, and frankly, your cheapest defense. But let me be clear, this doesn't mean just owning 50 different tech stocks. That's not diversification. That's just betting on one thing 50 times. Real diversification means owning different kinds of assets, stocks, bonds, maybe some real estate, some gold, that all behave differently in different situations.
And this is the absolute key takeaway. Forget about trying to find the next Amazon. The single most important decision you will ever make is your asset allocation. How you split up your money between those big categories, stocks for growth, bonds for safety, that decision is going to have a much bigger impact on your success than trying to pick individual winners. So, for example, a conservative portfolio like this is all about protecting what you have. This is for someone who maybe can't afford to take big hits, like a retiree. See how most of it is in debt, like bonds? That's the anchor. That's the stability. The smaller piece in stocks is just there to add a little bit of growth. Now, this is more of a balanced approach. A moderate portfolio like this is designed for good, steady growth without going too crazy on the risk. You could say this is a classic setup for someone who's still building their wealth over the long haul, but wants a much smoother ride along the way. It's a great mix of offense and defense.
And then you have an aggressive allocation. This is for someone who has a lot of time on their side and a high tolerance for those big market swings. They are all about maximizing those long-term returns. But, and this is important, notice that even here it's not 100% stocks. A pro never ever goes all in on just one thing. There's always a defensive component. So, you've built your fortress. You've got your asset allocation set up. Fantastic. But a fortress isn't something you just build and walk away from. You have to maintain it. So now let's get into the actual tools and, more importantly, the discipline that pros use to keep that structure strong year after year. This right here is called rebalancing, and it might be the most powerful and honestly the most unnatural feeling tool there is. Here's how it works. When stocks are on a tear and making you tons of money, your natural instinct is to just let it ride. But rebalancing forces you to do the exact opposite. It forces you to sell some of those high-flying winners and buy more of the stuff that hasn't done as well. It's a systematic way to force yourself to sell high and buy low and keep your risk exactly where you want it.
And then there's position sizing. The goal here is brutally simple: survival. By putting a hard cap on how much money you can put into any single idea, you are guaranteeing that even if you are catastrophically wrong, if a stock goes to zero, it won't take your whole portfolio down with it. No single bet is ever allowed to sink the ship.
And really, before any of this investing stuff, you have to have these non-negotiables locked down. An emergency fund isn't an investment, okay? It's your escape hatch. It's the cash that stops you from ever being forced to sell your investments at the worst possible time. And insurance? That's the ultimate firewall against those catastrophic life events that can destroy decades of hard work in the blink of an eye.
Okay, we've talked about market threats, we've talked about portfolio strategy, but we've saved the biggest, most dangerous risk for last. And it has nothing to do with the stock market or the economy. It's the person staring back at you in the mirror. This quote just nails it. It really gets to the core of what professional risk management is all about. Because after all the charts, all the analysis, all the spreadsheets, more money is lost to bad behavior than to bad investments. Your own emotional decisions are, without a doubt, the #1 wealth killer.
And here's where you see the difference in real time. When the market is crashing and it feels like the world is ending, the amateur lets fear take over. They sell everything at the bottom, turning a temporary paper loss into a permanent, devastating one. The professional, they prepared for this. They stay calm, they stick to the plan, they rebalance. And very often, they see all that panic as a huge buying opportunity.
So at the end of the day, that's what this all boils down to. You can build the most perfect, most diversified portfolio in the world, but it won't matter one bit if you can't control your own emotions when things get scary. So the final question you have to ask yourself is this: who's really in charge of your money? Is it you or is it your fear?